Welcome back to the deep dive. Okay, today we're tackling something that can be pretty complex for investors. We're looking at the 9-month consolidated financials and activity report for Çimsa, Çimento, Sanayi ve Dikari AA. And if you've ever glanced at a big Turkish corporate report lately, hyperinflation accounting TMS 29 makes things, well, technical.
It really does. You see numbers adjusted for lira purchasing power as of September 30th, 2025, and it uh, it can feel a bit dense for individual investors. So our mission today, cut through that complexity. We want to translate these TMS 29 results into, plain English, show you where Simsa's winning, where the challenges are, and what their big strategy actually means for the bottom line. Basically, we want you to walk away understanding the company's real health, not just the headlines.
Absolutely. And look, if this deep dive helps you decode the numbers, if you find it valuable, do us a quick favor. Hit like, subscribe, maybe share it with someone else who's trying to figure this stuff out. Right, let's start with the basics. Who exactly is Çimsa, and why are they important, especially globally?
Okay, so Çimsa, founded way back in 1972, headquartered over in Ataşehir, Istanbul. Their core business is pretty straightforward: cement, clinker, ready-mixed concrete production, and sales. Domestically, they've got 3 big integrated factories: Mersin, Eskişehir, Afyonkarahisar. But here's the thing that really sets them apart: their global niche, white cement. They're known as one of the top 3 brands globally in white cement.
Wow, top 3. Okay, that's not just basic cement then, that's specialized.
Exactly. It's a higher margin product. And that specialist status probably explains why their recent strategy has been so, ambitious. They're clearly pushing for global reach, mainly through this subsidiary, Çimsa Building Solutions BV, based in the Netherlands. They hold about 68% of that.
Right, the Dutch subsidiary. So that's like their international command center.
Pretty much, yeah. It manages their investments across Spain, the U.S., and Ireland. And the really big move, the one impacting these financials, was the acquisition of Manoc Holdings in Ireland. They wrapped that up, getting a 94.7% stake around October 2024.
And Manoc wasn't just buying more cement capacity, was it? It was about broadening their scope.
Precisely. Manoc brought in totally new areas. We're talking precast concrete, insulation materials, even packaging. It's a significant shift, moving beyond just commodity cement into, higher value-added building solutions.
That makes sense. So the strategy is about diversifying, less reliance on just cement.
Yeah, diversify products, definitely. Spread out geographically, too. And, crucially, increase their revenue coming in foreign currency. That helps cushion against, the lira's fluctuations.
Okay, that strategy context is helpful. Now, who's actually in charge? Who owns and runs Çimsa?
The ultimate parent company is Hakkı Ömer Sabancı, holding Eşu. They hold a direct stake of just over 54.5%, so clear control there. Looking at the board itself, it's got 6 members. 2 of those are independent members, which is standard governance.
And what about diversity on the board? Sometimes heavy industry lags there.
That's a fair point, but Çimsa actually does okay here. There are 2 women on the board: Demet Özdemir, who's an independent member, and Seval Kayor, a member. That works out to 33.3% representation. For this kind of industry, that's quite notable.
Good to know. And the sheer size of the operation, how many people are we talking about?
It's substantial. As of the end of September 2025, they had around 2,016 employees. Broken down, it's about 12,238 blue-collar and 778 white-collar staff. It just underlines the scale. Running this kind of global network takes a lot of people power.
It certainly confirms we're dealing with a large, complex company. All right, let's get into the numbers then, the real meat of the report for 9M 2025. Given that ambitious strategy, how did the top line, the revenue, hold up? Hassalat looked pretty good, didn't it?
It looked excellent, actually. Really strong growth. Consolidated revenue jumped quite a bit from about 24.6 billion TL in the first 9 months of 2024 up to 33.1 billion TL in the same period this year. You can clearly see the impact of Manoc there. They added a whole new segment in the reporting, Yapı Malzemeleri ve Paketleme, building materials and packaging. So yeah, the expansion definitely brought in sales.
Okay, nearly 9 billion lira more in sales. Logically, that should mean profits soared too, right? But this is where things get a bit counterintuitive.
This is the key tension in these results. Despite that big revenue jump, the profit picture is, less rosy. Much less rosy. Gross profit only nudged up slightly, went from 5.85 billion TL to 6.46 billion. That's a pretty small gain compared to the revenue leap.
Okay, so costs went up significantly too then.
Seems like it. And even more telling is the core operating profit isas faliet karoe. This is, the profit from their main business activities. And that actually fell quite sharply, dropped from 4.36 billion TL last year down to 3.62 billion TL this year.
Wow, okay. So revenue way up, core profit noticeably down. That's a serious margin squeeze.
Mhm.
What's driving that? Is it just input costs in Turkey's environment, or is it the acquisition?
I think it's likely both. Definitely you have systemic pressure. In this high inflation environment, costs for things like energy, logistics, crucial for cement, they're probably rising faster than Çimsa can pass those costs on to customers, especially domestically. That's your classic margin compression. But second, yes, you absolutely have the cost of integration. When you make a huge international acquisition like Manic, there are always upfront costs. Merging systems, aligning teams, new operational setups. It often drags down profitability initially before you start seeing the real strategic benefits.
So they're kind of paying the price now for future gains.
That's likely how they see it, sacrificing some margin now for bigger market share and diversification later. And all of this, of course, hits the final number. Net period profit took a significant tumble, dropped from 4.4 billion TL down to 2.78 billion TL.
Right. But we have to talk about the hyperinflation accounting again, TMS 29. How did that play into this lower net profit? Didn't it offer some kind of boost?
It did, yes. It provided a kind of counterbalance. Remember we talked about the net monetary position gain? Basically, when you hold net financial liabilities like debt in hyperinflation, the real value of that debt shrinks over time. Accounting rules let you recognize that erosion as a gain. And that gain actually increased this period. It was 1.83 billion TL for the first 9 months of 2025.
Okay, hold on. So even though their actual operations were less profitable, the accounting for inflation gave them an almost 2 billion lira paper gain on the profit and loss statement.
Exactly. Without that monetary gain from TMS 29, the hit to net profit would have looked much worse based purely on operations. And another point on cost, their financing expenses actually decreased a bit,
Right.
went down from 2.25 billion TL to 1.79 billion TL.
Oh, that's interesting. Why would financing costs go down with all this expansion?
Well, it could be due to the structure of the new debt, maybe lower rates secured on some parts or timing of payments. But even though it went down, 1.79 billion is still a huge number. So yeah, lower financing costs helped slightly, but the overall burden of debt servicing still played a big part in that lower final net profit figure compared to last year.
Okay, so P&L is mixed. Strong sales, squeezed operating margins, helped a bit by inflation accounting, and slightly lower finance costs. Cool. Let's switch to the balance sheet now. Because reading this, there seems to be a really positive story around liquidity and debt.
Oh, absolutely. This is where management seems to have really executed well. The turnaround in net working capital is, frankly, dramatic. Think about it. At the end of December 2024, they had a deficit in working capital of nearly 7 billion TL. Huge pressure.
Right, that sounds precarious.
It does. But by September 2025, they flipped that completely. They ended the period with a working capital surplus of 3.31 billion TL. That's a massive swing, over 10 billion lira improvement in their short-term funding situation.
That's incredible. What does that mean practically?
It means much better short-term stability. You see it reflected in the ratios, too. The current ratio jumped from a concerning 0.78 to a much healthier 1.18. Same story with the liquidity ratio up from 0.57 to 0.79. It shows they have more liquid assets to cover their immediate liabilities.
Okay, so liquidity much improved, but you mentioned debt earlier. Did the overall debt level change much?
Not dramatically. Total financial debt stayed relatively stable, hovering around 26.7 billion TL. But the structure of that debt, that's the key story here. It's about managing risk. See, at the end of 2024, they were facing a potential crisis. They had 17.28 billion TL in debt due within 1 year. That's a huge amount coming due very quickly.
Wow, yeah, that's like a ticking clock. How did they diffuse that?
They pulled off a really smart refinancing deal. They managed to slash that short-term debt, the stuff due within a year, all the way down to just 6.19 billion TL by September 2025. A big part of that was taking the short-term loans they used for the Manic acquisition and basically rolling them into a new long-term loan package. Specifically, it's now a 5-year loan, and crucially, it has a 2-year grace period where they don't have to make principal repayments.
Ah, okay. So they pushed the repayment deadline way out into the future.
Exactly. They essentially converted urgent, high-pressure, short-term debt into a much more manageable, stable, long-term structure. It buys them breathing room, it radically reduces the immediate repayment risk, and gives them stability during this crucial phase of integrating Manic and expanding in the U.S.
That sounds like a major strategic win on the finance side, de-risking the balance sheet significantly.
Definitely. And you see a small related benefit too. Overall financial leverage decreased slightly. The total liabilities to equity ratio dipped from 1.11 to 1.05. So improved liquidity, radically restructured debt, slightly lower leverage. It's a much stronger financial platform now.
Okay, strong platform established.
Yeah.
Let's look forward then. Are they sitting back now or still investing? What are the big recent projects?
Oh, they're definitely not sitting back. Two major projects really stand out, highlighting the ongoing strategy. First, the U.S. expansion. They just got a new gray cement grinding facility up and running in Houston. That was mid-October 2025, so just after this reporting period closed. It's a big one, 600,000 tons per year capacity. This moves them beyond just white cement in the U.S. and into the much larger standard gray cement market there. Big step for diversification in a key hard currency market.
Houston, okay. And the second major thing, sounds like it's about sustainability.
Yes, green finance. This is crucial for their future, I think. Back in 2024, they secured some significant funding specifically for environmental projects. They got $25 million from the EBRD, that's the European Bank for Reconstruction and Development, and another $70 million from the IFC, part of the World Bank Group. And this isn't just general cash, it's earmarked. It's specifically for things like using more alternative fuels, investing in renewable energy sources for their plants, and bringing in technology to cut emissions.
So they're using international finance to fund their green transition. Is that backed up by actual R&D work?
It seems so. They highlight their R&D center, Formylfane, and they mention specific projects that sound quite innovative. Things like NovaBind, that's about developing new types of binders that are high performance but have a lower environmental footprint.
Right, greener cement, basically.
Sort of, yeah,
Sure.
or alternative binding agents. Then there's VisionSem and SmartSem. These apparently use AI modeling to predict clinker and cement quality. The idea is to improve consistency, reduce waste, which ultimately lowers costs, and the carbon footprint.
Interesting. Using AI in cement making.
Yeah, and other projects like ActiveAim to use more alternative raw materials, again, cutting emissions. They're also involved in a Tubatac SAM project called 3D Mortar. That one sounds really cutting edge, using waste materials to create sustainable mortars for 3D printing and construction.
So this R&D isn't just window dressing. It feels like a core part of their strategy.
I think it has to be. Look, major markets like the EU are bringing in carbon taxes, stricter rules. If you don't invest in greener tech now, you could face huge costs or even lose market access down the line. And offensively, if they can develop these high-performance, low-carbon products like NovaBind, they can potentially sell them at a premium to builders who need to meet sustainability targets. It's future-proofing.
Makes sense. Okay, almost ready to wrap up. Let's just quickly cover a few important details from the footnotes. What about shareholder equity and dividends?
Equity saw a modest rise. Total equity went from about 40.2 billion TL to 41.7 billion TL, and they did pay a dividend. Back in April 2025, related to the 2024 profits, they paid out about 907 million TL gross. That figure is inflation adjusted, of course.
Okay. Any significant risks noted, like lawsuits?
Yes, they've set aside a provision of 54.7 million TL for lawsuits where they think the risk of losing is pretty high. That seems like responsible accounting. And importantly, there's a confirmation about related party transactions. Management states that all deals done in 2025 with the main shareholder, Sabancı Holding or its other companies, were done at arm's length, meaning on fair market terms, no special favors that could harm Çimsa.
Good. And finally, any major events after this reporting period ended on September 30th?
Yes, one more acquisition popped up. Their subsidiary, Afyoncimento, is buying a business line called Kratos from Kordsa Teknik Textil. It's focused on construction solutions, cost is about $10 million. It seems to fit right into that strategy of moving towards more tech-focused, value-added materials.
Okay, so the expansion continues even after the period end. Right, let's try and pull all these threads together. How would you summarize the story of Çimsa's first 9 months of 2025 for an individual investor trying to make sense of it all?
Okay, the big picture. I'd say it's a company in the middle of a really major, quite aggressive transformation. On the plus side, they delivered that strong revenue growth, largely thanks to Mananock. And critically, they pulled off that debt, restructuring a huge financial de-risking move that really shores up their short-term stability. That's a big positive. However, that growth and the whole integration process came with significant costs. Core operating profitability got squeezed, hit by both domestic inflation pressures and the expenses of launching this bigger global platform. So, the takeaway is, management's focus seems squarely on the long game, building international market share, diversifying, and investing in sustainable tech for the future. But they're accepting lower margins today to achieve that.
Right. Which leads to a really important question for you, the listener, to think about as you track their progress. We've seen huge investments, integrating Manic, refinancing all that debt, launching the big U.S. gray cement plant. The key question is, when will the benefits from all this spending start to outweigh those integration costs and the inflationary pressures? When will we see those strategic gains translate into consistently better, more stable core operating profit margins? Maybe in 2026, further out. That inflection point is really the crucial thing to watch.
Absolutely. That's the real test of whether this ambitious strategy ultimately pays off for shareholders.
Indeed. Well, that's all the time we have for this deep dive. We hope this helped make sense of Çimsa's complex results. If it did, please do hit that like button, subscribe for more analysis, and feel free to share this. We'll be back soon.